Welcome back to Two Gents, Two Cents, brought to you by 15 Minutes of Finance. This is episode 20, When Should You Sell? Now, the purpose of this episode is to sort of address, I would say, a trend in our topic so far, where we stick by this, but we consistently encourage, especially young investors, you should be okay accepting some level of risk. The market goes up and down, but the downs usually recover very quickly. And if you're not in retirement, if you're not close to retirement, those downs don't affect you. Just ride it out and your market value will go up. And you don't create losses, you don't lose your money unless you sell at the bottom, right? So you want to ride the wave, make sure you don't panic sell at the bottom. That being said, financial advisors across the country have jobs buying and selling securities. So that kind of begs the question we realize that we really haven't ever answered, which is, when do you actually sell? When does the decision and the analysis of the market and your current portfolio say it actually is time to get out of this position? It's not just something we should wait to rebound out of the bottom. So, James, kind of what's your first impression under this kind of umbrella topic? What informs primarily your decision when you do decide it is actually time to sell this stock out of a client's portfolio, not simply ride the wave out of the recession?
Yeah, so one excellent question. And there's many facets to this answer, and we'll keep it to two different scenarios. One is the overall market, right? So someone's just in ETFs, mutual funds, it's very broad, and then also like individual equities, right? So Brandon just specifically asked me about how would I evaluate a stock. My favorite financial professional, Peter Lynch, he was a fund manager for like 30 years at Fidelity, has one of the best track records in the history of finance. Like I think he averaged like 30% a year in this fund, which is ridiculous. That's crazy. And if you were to look at his fund by Morningstar rating, which is, think of that like a company that it's like a hotel rater, like, was this hotel 3 stars, 4 stars, 5 stars? He's constantly had the like riskiest quote unquote rating that Morningstar could give, and he absolutely killed it. So he didn't get a good rating, and he was doing really, really well. So his advice or how he handles this, I take very seriously. And also, I'm a huge fan of his strategy. So his answer to that would be when the story stops making sense. So you get into a company for a story for the most part, right? When you're so his example was La Quinta. Okay, La Quinta is a hotel chain that he was it's one of the things that put him on the map as an investor. One of the very first investors way back when in the 70s or 80s, whenever he started doing it. And that story for him never stopped making sense. So he constantly held, and that ended up being what, in the industry, they're called 50 baggers, when something 50x's, right? So 50 times. So he made 50 times his return on that, and he never sold. But right before he left, they did sell because the story changed. So when you decide to invest in something, the broadest, most general example or answer I can give you is when the story changes. And if you're investing in stuff without a story, it's probably also time to sell if you don't know why you're in it.
So this brings up a good point. So if you're analyzing companies constantly, you're managing portfolios, you're following lots of different companies per sector, that answer makes a lot of sense. My thinking about all the people I know that don't invest, or they invest, they don't know much about it, they're scared to do anything other than a full index fund.
Right.
It seems like following the story at all very quickly allows you to fall into the pitfall of buying at the high and selling at the low, because if you're selling and buying based on the story, but you're not an experienced investor, it can be very easy to get swept up in the story.
Absolutely.
And if you're getting swept up in the story, you're buying or selling later than you should be, because you're doing what the market has already reacted to and created a story about. So how do you balance those two things? You don't want to panic sell because the story is that it's down, but you are trying to follow when's a good time to invest in these companies based on the narrative surrounding those companies. So how do you follow the story without falling into the pitfalls of panic selling or buying at the height?
So this is it's a loaded answer, but it's honestly a good one if we're sincere about it. So if you have 5 or less years and you're going to need your money, I would tell you don't buy any more new stocks. It just doesn't make sense. You don't really need the money, or you don't need the risk. Sorry, you might need the money for sure, but you don't need the risk. When you buy individual stocks, you have relatively one of the most dangerous risks is that you're not diversified, right? That's what everybody's talking about, diversification. It can work with you and it can work against you. It almost always works against you in the short term. Okay. So if you have 3 to 5 years left, don't be getting into individual stocks. Just buy the basket of stocks, or don't buy stocks at all. Hopefully you've done a great job saving or investing, and you can just sort of ride out what you already have. But if you have time, which is again the most important thing with investing, if you have time, diversity isn't really always on your side, because the more you diversify, essentially the thought process is the lower your return because you're not focused. So a good example would be NVIDIA. Okay, NVIDIA is at $135 right now. It's had, whoever knows, a dozen stock splits. One share in 1999 would have been 40 cents, right? Yeah. Now, effectively, if we're trying to calculate out the stock splits, it's probably like a $10,000 stock. That's an insane ratio, but that would have been all you were in, you would have had a diversity risk, right? So, or a concentration risk, I guess we would go with it. So how do you know to sell? By following the story. It's all going to depend upon your time, right? So your time that you have left. If you have a long time, like NVIDIA example, again, they have been around since the 90s. They didn't start making money till 2018. Okay, that's a long time to wait for something, and we all know humans are greedy. They're impatient, immediate gratification. The advice would have been don't sell, but how many times can you really hear that and stick to that game plan, right? That story. Their story never changed. It just it didn't become relevant until later on. So the best thing you can do with stocks, one, is have time. But if you don't have time, the next thing you have to have is diversity. And when you sell one stock or buy another stock, ideally they don't interlap. They're different, right? So a lot of people talk about bonds and stocks being like a 30-70 portfolio. We don't like bonds at our firm. They're very specific to people's situations, but we diversify amongst our stock, right? So we have cyclicals, we have utility companies, we have tech stocks, we have food consumers, etc. Every single one of those has a time to sell, and it's all going to depend upon the client's situation. So if you're trading your own stocks, you have to look at your own individual situation, and remember, time is the most important thing. I just ranted at you. I'm sorry.
No, you're good. That totally makes sense. So let's talk about more technical answers.
Okay.
In the investing world, people who perform a lot of technical analysis, are there universal indicators that say it's time to sell this stock? It's down X amount. A certain ratio has reflected a poor enough performance. Are there universal indicators of when a company is not seen able to rebound anymore, or is it entirely dependent upon individual investor, firm, the company in question? Is there universality in this question?
Yeah, there is. Every investor is different. So again, there's fundamental analysis and technical analysis. Technical analysis, think of charts, numbers, kind of like the boring data. And then fundamentals a little bit more like, who's their new CEO? What did they just buy a bunch of tractors and there's no tractors for the competition to buy? Like those types of, that's sort of the difference in a very broad aspect.
Yeah.
There are like PE ratio, right? So like PE ratio is a good one. If you have a PE ratio of 15, you're considered like a good stock. But there's a thought process that once something hits 15 and the competitors, everybody else that it's competing with, right? So we'll use La Quinta. If La Quinta is at 15, but Hilton's at 11, you should sell La Quinta and get into Hilton because you want that 11 to 12 difference, or that 11 to 15 difference. That is much more reasonable for Hilton to get to than it is for La Quinta at 15 to get to 18 or 20. Right. And so PE ratio, guys, that is essentially just how much you would have to spend to get $1. So if I have to spend $15 to get $1, it's much less lucrative for me to get to 18, or it's much harder to get to 18 to get $1 more. Hopefully that makes sense for you guys hearing it. It's much easier if I draw it out. But again, it's much easier for me to pay $11 to get $1 than it is for me to pay $15 to get $1. So that PE ratio is a really common one that's used. Another technical one is just the debt ratio. So I like to use gross margin. Other people use literally just the debt to equity ratio, but a gross margin ratio is essentially how efficiently are they making their money. So how much money do they have to borrow to make money? There's a whole bunch of metrics that you can use on the technical analysis. There's something called a stop order, which is very popular amongst day traders, this is part of the reason why day traders almost never beat the market, is because 10% is a really popular stop order. So if you have something that's $50, a stock, La Quinta's $50, they'll put an automatic trigger at $45. And the second it hits $45, they sell it. And what typically happens is they're not able to get back in at, they'll sell at 45 and maybe it goes to 43. They're not able to get back in quick enough, and then it'll go to 46. And it's like, oh, now I missed it, right? Stocks go up and down 10% constantly. So the buying and selling of that, it's such a game that you just lose more than you win. And another good example that's not technical, it's definitely more fundamental, is that anytime you see something in an article, or an article will come out that'll say Vanguard Growth Fund just bought NVIDIA. Once that's happened, you've missed some of the best growth. Okay, the most important growth in a stock is in the early stages. So you want to be early on stuff. You almost never want to be on time, because what Vanguard is saying is, oh, this stock might go up another 5%. But you're thinking they just put $25 million into this stock. They must think it's going to go to 60%. That's not how these things work. What Vanguard has done is they've said, oh, it's already gone up 30%. So now we just want to cap on a 5% gain. And because they have so much money, they can do that broadly over so many things.
Yeah,
so
right.
That's one of the big things. Once you've seen it in the news, I would definitely not. It's time to sell. Get it out of there, because the growth is already done. Usually 90% of the time.
And so just to clarify, what you're talking about is if you see in the news that it's, hey, this company, have you heard about this company? This company's doing well. It's time to sell as a growth option. You're not saying the moment you see a stock in the news that's losing money, you sell.
No, and I don't mean like CNBC or like Jim Cramer either. I mean like Wall Street Journal, like the things that don't talk about stocks. Because Jim Cramer, who, by the way, crazy horrible investor. He did good one time, made a bunch of money, and then he hasn't done well since. So anytime he says something's a buy, I go, oh, maybe I should consider a sell order. But no, I mean just like in general news topics, right? Like, sure. NVIDIA, everybody knows about NVIDIA now because it's just been everywhere. Well, NVIDIA, if you would have bought NVIDIA 5 years ago, even $1,000 of NVIDIA, I bet you're a millionaire, a multimillionaire. So it's things like that where it's like, oh, NVIDIA's kept going up, but now it's up 10%, 15%.
Right.
Whereas before it made the Wall Street Journal or the Washington Post or any of these just generic news stations, I mean, there was 200, 600, 1,000% growth on the table that you would have had to have already been in it for. So.
Yeah, for sure. Let me clarify one thing, and then I'll ask a follow-up question on that. So I don't think we ever actually said what it is. So PE ratio means price to earnings, for anybody listening. So if a company earns $100,000, the total value of all their stock is $1 million. That's a 10-to-1 price to earnings ratio. So the value of all its stock compared to, as a ratio, the amount of total income the company earns. So price to earnings. It's a comparison, as James said, of how expensive is it. Well, I have to pay $10 to every $1 they earned versus a price to earnings of $2. There's investors that look for negative price to earnings ratios for companies that are in the red and are investing in research and development for new technologies, things like that. Generally, growth stocks are going to have negative or much, much smaller price to earnings than companies like Amazon, Walmart, that are established, very, very stable, large companies. Okay?
And I mean, I could look it up right now, but like Nvidia's, I bet you it's like 40. I bet you it's like 40 right now, which is really any smart investor would be like, don't invest in that, which I feel that exact way.
And this is where we also then get into conversations about market cap, which you talked about a couple weeks ago in 15 Minutes of Finance, which is the total market capitalization, aka the total value of all stocks. People look at a total market cap, which I think puts Nvidia in like one of the top 10 companies based on market cap, very, very high. They look at price to earnings and it's 40, and you think there's no way this can keep going up when it's more expensive than any other stock. Like how valuable can it actually be if it's this much more expensive than its competitors?
So that there is a fallacy behind that. Like it's the market cap fallacy. Like it can't keep getting any bigger. That's not true. Nvidia chips are in everything. It takes like 1,000 chips per vehicle or something. So like there's absolutely going to be a chip market out there.
Sure.
So Nvidia can absolutely keep getting bigger. But just back to their PE, what do you think it is?
37.
63. It is 60.
That's very high for our listeners out there. It's a very, very high price to earnings ratio.
We really want as investors. So like I'm investing other people's money, right? I have to have a different level of care and diligence with their money, and like I'll even be upfront. Me investing other people's money, I have a way better return than on my own money. Like I'm almost even with my money, because in my head I'm like, let's take risks, but then with other people's money I'm like, no, we have to be very calculated. I'm very careful with other people's money. So these ratios and these the fundamental analysis we have, did they get a new CEO? So like Nike got a brand new CEO. The new CEO, okay, he started his career at Nike as an intern. You could see his resume. It's like Nike intern, and then it was Nike salesperson, and then it was Nike floor manager. And over the last 40 years, he slowly built himself up. Now, Nike's done really, really bad these last 3 years. Okay. I was going to sell Nike. I've been holding it for a long time, even for some clients, but now they have this new CEO that understands it from the ground up. Man, that's a really good story. I want to just hold. I just want to see what this guy's going to do, right? So the story's changed, and now instead of selling, I want to hold on to it. And I'm not so worried about the PE or the gross margin ratio or, the earnings per share, all those types of things. I'm not really so worried about, because it's a new story. It's a new direction.
Yeah. So let me real quick ask a follow-up to the last thing that you were talking about. In the news, if it's in the news, it's you're behind the story. You're behind the time to invest. How does a person without a lot of time or investing experience ever beat the news cycle? Like, how do you know to invest in NVIDIA when Wall Street Journal hasn't talked about NVIDIA yet? I hadn't heard about NVIDIA as a company name until we talked about it as business partners. So kind of, is it possible to beat the news cycle as an individual person? Should you be making buy-sell decisions as an individual person? Or does just the fact that that's true mean that the average person, you need to just be in index funds because clearly you're not able to beat the news cycle unless you're diligent?
Yeah, again, it's so hard because for every 100 people who lose money trading stocks, there's one person who kills it. So, and you'll hear the loudest person in the room is the one everybody knows. Well, that's what you hear about, is that one person who did really, really well.
Shout out to the crypto bros out there. I hear a lot of you talking about making money. I do a lot of taxes for people who lost money. So there's a big disconnect between, the volume.
It just doesn't, statistically, you're not going to do well. One, you don't have the time that I have as a professional.
Yeah.
Okay. Two, you are reading news and you're getting the stuff that's already out there. You're getting the Wall Street Journal information. Like the only thing I can think of, like I have a doctor client who he invested money in Netflix, Nvidia, and AMD in 2018. Okay. All on his own. They all dropped 20%. And he's like, I'm scared to lose my money. I got to get out. And he did all of that on his own. Well, I was looking at what they are today with the amount of money he put in. He'd have $8 million more if he would have just stayed.
Yeah.
Right? So the trading of your own stocks is an emotional experience. And you will mess that up. You just will. Again, because for every 100, there's one. Okay? And it's just 1% chance that you're the one.
Yeah, it's a really hard concept to understand that functionally stocks, there's different terms that we use in investing and projecting wealth, both on financial planning, taxes. There's, the present value of something. There's the future value that we project of something. There's the interest rate, how many periods it's going to be, right? That's how we do future value calculations. It's very hard to accept that in terms of need, your stock portfolio doesn't have a present value because it's not usable money. You're not paying a penalty in early withdrawing 401k money. You're not touching it until at least your mid-50s. Most people are not touching it until they're in their 60s and they've retired on Social Security. So it's very hard to conceptualize. I'm looking at a number when I sign into my 401k portal, but that number doesn't matter. This isn't money. It's not a checking account. I can't spend this money. I can't go to the grocery store and scan my 401k plan. It only has functionally a future value. And the future value is going to drastically change based on when you sell, when you buy, how much growth your account sees. And so two people can have $100,000 and 40 years down the road, they can be wildly different amounts, right? All based on decisions made along the way. They technically had the, quote, same amount of money, but the future value became very different. Your 401k plan, your IRA, it doesn't have a present value functionally. It doesn't have a value to you now. So it's very hard to log in and see a red number to see, oh, it's down 5.8% today. But that 5.8% it's a magical number.
It's not real.
It's not real because you still have the same thing that you had. If I have 3 shares in NVIDIA stock and it goes down 80%, guess what I still have? 3 shares of NVIDIA stock, right? You have ownership of a real thing, of ownership in a company, ownership units, right? Stocks are units of ownership in a real company. What you have doesn't change unless you buy or sell, but the value of it can drastically fluctuate with the market. So it's a very, very hard thing to really understand that I have the same thing today and tomorrow and the next day and the next day and the next day. The value goes up and down, but it doesn't really have a value to me now. It's the same object. I only need to try to figure out what its future value is going to be. And the time of what future looks like can be very different from two people.
And look, there's definitely a place for rebalancing. That would be a term that gets tossed around a lot. I have a couple of clients that at the end of this year, I definitely need to sell stuff because it's gone bonkers, and it's more important to them that they trim a little off the top, right? They trim a little bit off the top and then they can store that elsewhere, right? Like that, or we can reinvest that into different places or wait for a drop, like et cetera, et cetera. But I mean, if you have something like, again, Nvidia, the last 2 years, it's gone up 1,000%. I mean, again, I still think NVIDIA is the trailblazer of the chip market. Like, I probably wouldn't sell that one. But if someone was like, hey, you know what? just to be safe, I want to take some of those earnings. Yeah, rebalance out of that position, right? If something goes up 1,000%, and so you have 10 stocks and you have $1 million and you put $100,000 into each stock. Well, if one went up 1,000%, like you originally had 10% in each stock, right? You had a balance of 10% in each position. Like, yeah, maybe you do want to rebalance stuff back to that and take some off the top. I'll have to do that later this year for some people.
Right.
There's definitely a place for it. It just is going to depend. Like, you want to make sure you're in stuff that's going to, if you're in the growth stage, which you should very, very clearly be able to define where you're at. Are you in the conservative stage, the income stage, the I don't care what happens to this money, I don't need it growth stage, or are you in the I've got 30 years, let this bad boy ride stage? Like those things are very, very important. And if you can have the relationship with your stocks, like Brandon had just said, you have ownership units. It's not, $300 worth of NVIDIA. It's not. It's 3 shares of NVIDIA. Your life, you'll be rich because you're viewing it differently. And now when it comes time to use that money, now it's money. But right now, you own 3 shares of NVIDIA. You can show up at a shareholder meeting and ask questions and make decisions. Probably not if you have 3 shares, but you could at least show up, which is, that's valuable.
We call that voting by proxy. Yeah. If you don't show up, someone with more shares says that this person has a billionth of a percent. We'll vote for them by proxy. So the last thing I'll kind of say, and this is kind of overall summarizes this idea of, if you see the news, is it too late? If you can an individual who has another full-time job, can they beat the market? Does it take too much time to beat the market? Should you just be in indexes? This is what I'll say. If you've ever considered like working with an advisor and thought, I'm gonna manage my own money, I don't want to work with an advisor. In my opinion, there's only 2 ways to view a relationship with an advisor, and it's not wrong theoretically to view these either way. An advisor is not a real job, or you should have one. That's what I would say. Like, if it is possible that someone who spends their entire time doing fundamental analysis, doing technical analysis, gaining experience buying and selling, they understand how the market works, they've gone through multiple recessions, they've gone through multiple economic cycles, does that give them the experience to be 1% better at what they do than you are? If it's a real job, they should be able to do better than you can with your money by 1%. Because that's what most people pay an advisor, somewhere in the 0.8 to 1.5%. I think average is 1.2, I think.
Yeah, 1.17.
Across all advisors. So not me, is James, we'll use taxes, right? Am I 1% better at finding tax deductions? If I was free, that would be the conversation. If I prepared someone's taxes for 1% of the deductions I got them, is there something I know that they didn't know about being a business owner? Oh, I didn't realize I could write off a percentage of my phone bill. I didn't realize I could do a home office. I didn't realize how to write off my car. I didn't know I could pick either miles or gas. Am I 1% better? Everyone would have a CPA. Of course I'm better. People pay me hundreds of dollars to do their taxes. Most of the time, I'm worth that. When you look at an advisor and you look at, trying to beat the news cycle or even just trying to not make emotional decisions, is an advisor 1% better at that? If so, they pay for themselves and they gain value to your account, right? If they're not 1% better, it's not a real job, guys. If James can spend a decade doing this and he's not 1% better than me, what he does is not real. 10 years of experience should make you 1% better. Playing basketball makes LeBron James a lot better than 1% better than Joe Schmo down the street, right? I've built escape rooms for 5 years, right? It's a very smorgasbord of skills. I have to wire up LED lights. I have to install doorways. I have to put floor down. I have to paint props, right? That's a whole mess of things. I guarantee you I'm 1% better at hanging doors than somebody else just because I've done it.
Definitely me.
Let me tell you, I'm better than 1% better than James at doing drywall because he's tried to help it. It's brutal to watch. I'm not sure if it's helpful at all, right? I've seen painters come in to do our hallways and you go, boy, are they 1% better at painting. They were out of here in 2 hours and there's not a single, drip line. I spent hours doing my walls and it looks like garbage, right? So an advisor is either 1% better and worth their fee, or you just don't believe there's such a thing as beating the market. And the only real way to invest is being in the S&P 500, being in the market, and an advisor can't beat the market. That's a tenable position. There are people who don't believe you can beat the market. There's a lot of historical performance that says most advisors don't beat the market. That's fine. If you believe an advisor is a real job, work with one. Otherwise, you don't believe advisement is a real job. Those are the only choices because they don't have to add a lot of value. They don't have to increase. They're not charging 8% of your portfolio. They're charging around 1%. So it's a real job and you should have one, or you can't beat the market and you don't need an advisor. They're both legitimate positions, but you shouldn't be in the boat where you say, I think I really like what advisors say, and like I know some people who work with great advisors. It's just not for me. It is for you. Earning more money is for you. So if you think advisors are legitimate, work with one. Find one that you trust. Otherwise, you're just in the camp that says there's no such thing as playing the market. There's no such thing as financial advisory. The market always wins. It's fine to believe that. And then you probably don't need an advisor, but know where you stand because there really isn't a middle ground between those two things, given how little performance has to differ with or without an advisor for it to be worth it to have one.
And just to summarize the question, when do you sell? It's when your story.
It's the point of the episode.
Well, it's when. Well, to talk about what he said too. If 1% over 30 years could be millions of dollars. So depending upon how it's invested, you might say, oh, it's not worth 1%. It might not be worth it right now. It might not be worth it in 10 years. But over a span of 20, 30 years, 1% is absolutely worth it. $100,000, $1 million. It could be a large sum of money. So definitely worth it. But to back to the question, when do you sell? It's when your story changes. So, I'm going into retirement. Time to sell. Okay. Not everything, but something. Or, we just had a kid. Probably time to be a little less risky with your money. Or I don't know, massive health concern. Okay, well now I need to make sure I'm a little bit more conservative with my funds. Whenever your story changes, that's when it's time to make a selling decision.
I really like that answer. It took 30 minutes to get there, but I really like that answer.
It took me 30 minutes. I was you know what? It's time to just say what.
Technical, fundamental, whatever. It's about me. It's about my story. I'm the main character. No, that's I think a really good answer. It's comes back a lot to what we talked about yesterday. Last week of what is risk tolerance and how does risk and time correlate. That really is the number one thing. Your situation determines how much time you have. The time you have is the most powerful thing in an investing world with compound interest. So your time and your situation is going to be the primary determiner of when you should get out and when you should recalculate and, reposition your portfolio.
Amen.
All right, everybody. Thanks for joining us for another week of 2 Gents, 2 Cents. We hope you learned something. Please comment on the video. Send us a message. Any question you want us to answer. Any future topic you'd like to hear covered and broken down in depth. Otherwise, we'll see you next week. And as always, invest early.
Invest often.
See you next week.